Geopolitical tension between the United States, Iran, and China is often defined through the lens of military security and nuclear containment. Parallel to these security concerns is a massive economic arrangement, the 25-year Comprehensive Strategic Partnership between Tehran and Beijing. The agreement commits $400 billion in Chinese capital to develop Iranian energy and infrastructure. The structural roots of this partnership extend back to the global oil shocks of 1973 and 1979. Linking these eras is a single structural tension: the preservation of the petrodollar. Within this system, the global oil trade functions as a debt absorption engine for the United States economy. Controlling the currency denominator of international energy is a critical component of U.S. national security and fiscal stability. The current system relies on a framework established in 1971. Facing a dwindling gold reserve, President Richard Nixon suspended the convertibility of the U.S. dollar into gold. This effectively ended the Bretton Woods system, leaving the U.S. fiat currency without a physical global anchor for demand. To compensate, the U.S. reached an agreement with Saudi Arabia to price and trade oil exclusively in U.S. dollars. This forced all energy importing nations to acquire and hold U.S. dollars to maintain their fuel supplies. This process is known as petrodollar recycling. Oil-consuming nations pay OPEC members in U.S. dollars, creating a massive capital surplus for oil producers. In the second phase, OPEC nations use those surplus dollars to purchase U.S. Treasury bonds. This reinvestment cycle finances U.S. deficit spending and contributes to lower domestic interest rates. This mechanism transformed crude oil into a primary collateral base for the U.S. national debt. This recycling loop is vulnerable to sudden interruptions in oil production. The first major interruption occurred during the 1973 Arab oil embargo. The immediate supply constraint caused domestic energy shortages and rapid price increases across the United States. A second test followed in 1979 with the Iranian Revolution. Massive political upheaval reduced Iranian oil output from 6 million barrels per day to just 1.5 million. This chart shows the WTI spot price for crude oil from 1950 to 2020. The vertical price spikes highlighted here correspond directly to the supply shocks of 1973 and 1979. These spikes resulted in a transfer of global wealth to oil-producing nations. As this chart of gross borrowings indicates, the influx of these petrodollar surpluses into the banking system triggered an expansion in international lending and subsequent debt crises. These historical events demonstrate how the stability of the global financial system has tracked with a steady dollar-denominated flow of oil. The current expansion of China's Belt and Road Initiative is introducing a new variable to this system. The Iran-China Comprehensive Strategic Partnership creates a direct trade link outside of the 1971 framework. Beijing provides investment capital for Iranian infrastructure in exchange for a discounted long-term oil supply. The agreement covers a volume of 1.5 to 2 million barrels of crude oil per day. Because of its isolation from the Western SWIFT banking network, Iran cannot settle these trades through traditional dollar-based clearinghouses. Consequently, these transactions are settled in yuan, entirely bypassing the U.S. dollar. This represents a de-dollarization vector that disrupts the petrodollar recycling loop. When oil is traded in yuan, the revenue never returns to purchase U.S. Treasury bonds. If this settlement model scales to other BRICS nations, it removes the global requirement for nations to hold large dollar reserves. Without the recycling loop, financing a $35 trillion national debt would exert significant inflationary pressure on the U.S. domestic economy. The speculative 2026 scenario, Operation Epic Fury, serves as a model for how the petrodollar system might be defended through kinetic force. The scenario begins with U.S. and Israeli airstrikes targeting Iranian nuclear and leadership sites. The simulated Iranian response avoids traditional military targets. Instead, retaliation focuses on the energy infrastructure of U.S. allies in the Persian Gulf. Strikes on the Ras Laffan complex in Qatar disabled 20% of global liquefied natural gas production. A drone strike on the Fujairah oil terminal in the UAE disrupts a major regional export hub. The strategy aims to remove large volumes of crude from the market to spike the global price of oil. This places immediate pressure on the Strait of Hormuz, where 20% of the world's oil supply is in transit. These strikes demonstrate the physical vulnerability of the trade routes that support dollar-based energy markets. The ultimate objective for the U.S. in this scenario is a complete regime change in Tehran. Reintegrating Iran into the SWIFT network and the dollar-denominated trade system is a primary fiscal objective. The petrodollar functions as a central pillar of the U.S. fiscal model. From this perspective, military action in the Middle East serves as a direct defense of the currency itself.